Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. Um, Big changes that we finally got some data on, and that is the number of price changes per week. Those are on a list price now, on the list prices. Doesn't mean prices are dropping or anything, it just means the list prices. Um, Changed in price reductions of 56% of the listings that are out there. The median list price change was $10,000. So that is a big number there. Now, obviously, the average is going to be a little bit higher than the median. And so I'm going to dig into the numbers a little bit more with you here, but that uh, is a big number to think about during this time of year, because usually this is our busy season. Now, part of that could be because, we got people who, overprice their properties, obviously. Um, and that's a thing because right now, home buyers are very, very picky. They're very picky right now, and rightly so, because prices have gone up, interest rates have gone up. And although we had some numbers end the week out well, they're still higher than people want to see those rates. So demand, there's a lot of pent up demand. There's a lot of people waiting to see what's going to happen. There's a lot of people that just can't afford to buy right now with the prices and the rates. But we're going to take a look and see what's going on with this. So let me go ahead and share my screen here with you, and we'll get right into it. So right now, nearly 40% of home buyers couldn't afford their home if they were to buy it today, according to some surveys that were done by um, Redfin and some other institutions. So that's happening. And I mean, when prices pretty much double and rates pretty much double, hello, we've been talking about that for 2 years now. The thing is, a lot of people, if they do need to move or want to move, that is something that they're going to do anyway. People don't buy homes or whatever necessarily because rates are lower or not. They buy because they need to, get a bigger house, get a smaller house. They need to move because of work, family, whatever the case may be. I've never really gotten a call because somebody's like, "Hey, the rates dropped. I want to buy a house now." That sort of thing. Usually they have to buy because, maybe they got married, they got another, family's growing, whatever the case may be. So, um, another poll was taken here, and out of that survey that was done, nearly 2 in 5 homeowners don't think they can afford to buy their home today. So that is a huge number to take a look at there. But again, these are not things that are really surprising with what's going on. And then you add on inflation, even though, yes, the rate of inflation has dropped quite a bit. If you take a look at how they calculate things today, anyway. But a lot of those inflationary factors are baked into the pie, so to speak. So, new home sales inch higher despite 7% mortgage rates. Now, again, when you see these mortgage rates, we talk about this all the time, and you see these numbers thrown out there in the sevens. Those are the average across the country. A lot of that's going to be taken out of obviously from the retail mortgage sector. We like to work with mortgage brokers, so typically, like, just in the last few weeks, we've seen FHA buyers, when we show you these numbers here as we do this, we see that FHA buyers getting rates in the fives, mid fives, conventional and around six or low sixes. So big difference depending, not just like not all realtors are going to be, created equal. Same thing with mortgage lenders and loan officers. So it's like any industry out there, right? So, Fed meeting recap from the last couple of days. Powell pretty much rules out a rate hike, which was good. That gave us some momentum the last couple of days in the bond market, which means we've got rates drop a little bit as central banks' next move happens. And what the big thing that they're emphasizing is the jobs report, which came out today. So, U.S. growth totaled, because this is what they're looking at. They're looking at, you know, a hurting labor market is different than a broken housing market, right? Or I mean, broken labor market. So, although there may be some issues in the labor sector, It hasn't broken yet. Okay. What does that mean? Well, right now, let's take a look at this headline. It says US job growth totaled 175,000 in April, much less than expected, while unemployment rose to 3.9%. So that's rising, that's getting higher. So again, it's crazy, sounds nuts. It is crazy that they're waiting for the labor market to break, but they're trying to tame inflation by doing these things. If people are out of work, they don't have jobs, they're not, going to spend the money. You have less inflation is the theory behind it. They want to get to 2% inflation rate. We're still higher than that. Even though we were all the way up to 9 and now it's a little over 2, you know, they want that 2 mark because Alan Greenspan told them that 3 decades ago. So they got to go by that. So anyway, that's what they're doing. And it rose to 3.9%. Now, where it breaks is right around 4.2, 4.3. Okay, that's when you're going to see alarm bells go off. The thing to look for before that happens is unemployment claims going up for construction. For construction always happens before every recession. So, and that's basically where they're trying to guide us into. Again, sounds crazy, is crazy, but that's what they're doing. Um, let's take a look at this. What they've got to say here is the unemployment rose higher, consistent trend, recent trends, healthcare led job creation, increases social assistance, transferring houses and retail. Okay, so following the report, traders priced in a strong chance of 2 interest rate cuts by the end of the year. We probably won't see any rate cuts from all the indicators. They took the June, July idea right off the table. We talked about that a couple of weeks back. So now we're looking at probably around September at the earliest, if at all, depending on how things go in the bond market. But a lot of this is just messaging. So Powell says this, says these things, and the market responds and it gets a little bit better. So anyway, that's what we've got to keep an eye on is this growth. Now, here is, let me just show you this real quick. Whoops, wrong one. I got ahead of myself there. Okay. So total housing inventory, see that black line going down? Okay. Sales per month, it's definitely on the rise here in Phoenix. This is nationally. For Phoenix, it's on the rise for the sales per month, and this time of year, it's supposed to be, but it's not as high as you know, the like last year in the last couple of years. So believe it or not. Yeah. So people are maybe getting a little bit disenfranchised with these rates and higher costs. So they're kind of seeing, what's going to happen here. Some of them are waiting, some of them just can't afford to do it. I get this question a lot. Number of consumers, while we're right here, I'll just do this now, with new foreclosures and everything. Look at the black line there. Look where we were, going back back into these other quarters and years. You can see that black line where it's going up, of course, during the crash. Now, it's just kind of leveled off. There was a little bit of an increase after and again, you got to look at the numbers, not the actual percentages that they throw out there, because of the idea that after, during COVID, during the pandemic, we had the moratorium on those foreclosures. So that's something that always comes up all the time. Okay. Um, one other thing to throw out there, so I guess, as far as this labor market is concerned, I would just say, not yet, not yet as far as rates coming down. Once that labor market breaks, we're going to see those rates drop. Okay. So, I mean, again, crazy. But that's just what they are doing. Okay. Um, the sales per month, we just kind of went over that really quick, but yeah, it's basically it's on the rise, but it's just not as high as it's been for, going all the way back to 2020. It's just not happening. Again, rates are really stifling this. People are, very picky. I would say, look, if you're getting ready to sell a house and you want it to sell quickly, about a 3 to 5% rule is great. And what is a 3%, 3 to 5% rule? If you see damaged baseboards, if you see fading paint, paint that's not really touched up correctly or fresh on the inside or out, even cracked on the exterior, again, this is if you want your home to sell quickly, because right now we're sitting at about 78 days average on market. That means it may be taking over a month with the usual escrow periods, and maybe taking a little over a month, maybe up to even 5 weeks to get a property under contract. If it's not freshened up properly inside and out, doesn't mean you have to update everything, tear down walls, but it means what is there needs to be good and looking fresh. So and as up to date as possible. So people are looking at those little things that they're going to have to do down the road to make it theirs. And how much of that do they really want to do? Okay. Some of that you can say, yeah, there may be certain things like maybe, things like ceiling fans, maybe some light fixtures, stuff like that. Might be things you can put off to the side. But when people walk in and they see damaged baseboards, faded paint, um, inside or out, cracked, stucco, things like that, missing roof tiles, whatever the case may be, those are things that you're just kind of ticking off in their brain. I gotta do that, I gotta do that. And the usual buyer, is just thinking of the aggravation of it and the cost, of course, of doing that. So if you want your property to move, let's at least make sure it's as fresh as we can possibly get it within that 3 to 5% spending range, max, just to keep things, nice and fresh in there. Old carpets, stained carpets. It's gonna make the house sit longer. It's gonna bake in probably some more price reductions rather than just maybe spending a few bucks just to get that done and not having them tick off, ridiculous numbers in their head, oh, it needs a fresh coat of paint. It's gonna be, oh, that's 10 grand, when it's really maybe a couple thousand to get it done. So anyway, those are just some things just to think about if you're getting ready to list a house. Now, resale and new homes right now, nationally and in the valley are totally, totally two different ball games. And what I mean is, new home sales are actually doing great. Now, here in the valley, we are actually having a banner year for new home sales because they're offering all these buy down rates. I mean, I've seen rates starting off as low as 3.9%. Getting into a new home, I've seen them covering closing costs on top of that. So, I mean, when you're looking at even working with a mortgage broker at being in the mid, just without paying down any rates or anything, looking at being at, mid fives to, low sixes, depending on what kind of loan you have, that's something that makes a big difference in a payment for a home buyer. So I'm making sure that our clients understand this. Every builder is going to have different incentives. Some of them are even offering not only the lower rates, but they're offering front and back landscaping, even with turf. Um, you can still, depending on what part of the valley, get into a brand new home within the 300 range, mid 300 range, to low 400 range for the entry level. Again, depending on what part of the valley you're going to be looking in. They're offering, window packages as far as, window coverings and all that sorts of thing. So there's lots of things out there that I would say let's talk about. If you're thinking about buying a home, might want to be looking at resale. Now, there's a lot of things that or you might want to be looking at a new home because of all those incentives. Now with a resale home, you might have a little bit more in the way of, mature trees, mature gardens, mature, trees and bushes, things like that. A little bit more of a manicured type yard. You may have a pool already in there, all these sorts of things too that are nice. More mature landscaping as far as the entire community is concerned. All those sorts of things that are nice too. That we can also kind of weigh and measure both ways. But that's a big market right now, is that new home housing market. So keep that in mind. This is, again, this is millennials right now reclaim the position as the largest group of home buyers, and they are very picky right now. Trust me. Not only Am I saying that from the numbers, but anecdotally, talking to other realtors, other brokers, being on other boards and stuff, us on our own listings, going out with our own buyers. Buyers are very picky right now, and again, rightly so because of the cost. Okay, and there's even a little bit more inventory now that is out there for them to choose from. So they don't necessarily feel like, hey, if I can stay where I'm at right now and find what I want or wait a little bit. But I think that, overall, sentiment is, and the thought should be for most people is these rates are not going to come down dramatically anytime soon. I've talked about this many times. You see decades where rates kind of hang around a certain number, and that's something to keep in mind. But there are these other ways of getting lower rates. Like I said, getting into buy down situation, getting concessions from resale or new home sellers, all these different things. Working with a mortgage broker is going to be a big thing to look at. Month supply right now, well, let's just pull up the whole chart here. Let's see. Okay, so right now we're sitting at 78 days closed out market, 2.7 month supply. Uh, a balanced market for Phoenix is going to be right around 4. Okay, 3 to 4. We're pretty much there. I'll show you the Crawford Market Index in a minute. The absorption rate is at 37, a little over 37%. That's actually a little low. We like to see that more in the 40s. Average list price is 839. And average sales price right now this week is 608, a little over 608. So um, that price fluctuates a little bit, again, depending on the averages and price ranges and stuff that are selling. But this list to sales price ratio, 97.75, not horrible, but we usually like to see that in the low 98s. Okay, a little over 98. So active inventory down a little bit. Pending inventory is up a hair. What's gone under contract, just a hair. Again, nothing crazy going on in the short sales or foreclosures or anything like that. Nothing crazy happening there. Except for HUD down 100%. There's no HUD homes uh, when this was pulled anyway on the MLS. Closed units are going to be at a minus 6.3%. Okay. So we're seeing closings go down. Okay. Usually that number this time of year is definitely up. And this is kind of weak with the pending, and this is definitely with the active minus. That's a weakness. It shows, you know, that we're kind of just kind of hanging there. It's kind of like stagnant. We're in a balanced market. It's not like any big thing either way, but homes are sitting longer, so some sellers are more apt to give concessions right now. I almost would give a little bit of advantage myself to a lot of buyers right now and getting closing costs, especially with those new home situations, and getting concessions for rate buy downs and stuff like that. The majority of the market is still under that 500,000 and $600,000 range. We're looking at, you know, uh, 30% here, 25% and 200 to 399, and then below that is 6%. So, I mean, you're over 60% there with under $600,000 price ranges. So, anyway, the rest of it is moving right along as far as the luxury market. Those prices and that market is actually been moving right along up until recently. That's actually taking a little bit of a slight change in the numbers. So again, every segment may be taking a little bit of a hit there on inventory and what's available. All right. So the let's see. The other thing I wanted to show you was uh, once we do hit those recession that recession that we're coming into with especially when we see that labor market stuff happening I talked about earlier, that does not equal a recession does not equal housing crisis. And here's just kind of a quick history graph about that. Obviously 2008 was the outlier. 1991, it took a little bit of a hit, not much compared to 2008, but over 75 years, you know, that's basically, you know, the extent of it. The recessions, you know, usually housing does well because rates drop and then demand goes up and then equity goes up. So anyway, there's a quick look at that. Um, whoops, sorry about that. Okay. Let's see. Before, okay. And yeah, we talked about active listings. Okay. So let's just take a quick look here at the bond market. We saw that 10-year treasury was pretty much flat at the end of the week here. The 2-year took a dive, and a lot of that had to do with some good information coming out from the Fed finally, and also from the labor market stuff that we talked about because the jobs report, you know, April was much less than expected, while unemployment rose 3.9%. And so obviously that took a little bit of a hit there. So the bond market reacted. Rate ends week at lowest level since April 9th. That's good news. Rates drop from the bond market activity. And here's how they ended up. These are, again, average national rates. If you go through a mortgage broker or we set you up through a new home builder, we can definitely negotiate much better rates than that. Way better, way better. Okay. Not even close to that. The Cromford report. Okay. From 90 to 110 is a balanced market on the index for the Cromford report. Anything below 90 is a buyer's market. Anything above 110 is a seller's market. So we are at 110.8. So basically we're in a balanced market, guys. We're just in a balanced market. That's where we are. Nothing super fast is going to move either way. If you've got a home that's you know, super freshened up and priced to sell, um, you know, ready to go, I would recommend, you know, doing a kind of a coming soon with a big launch and everything, not rushing it at this point with the way things are, making sure everything's tidy up, you know, tied up inside now, again, like I mentioned. And we could certainly go through that with you in detail. Now, if you don't choose to do that, just know you're going to be on the market a little bit longer. That's fine. That's totally your prerogative. Some people just can't afford to do any of that freshening up. Again, that's going to just affect the time on market and maybe some price reductions baked in. Um, Supply index, just, you know, is we already talked about the supply, was not the greatest. Demand, not the greatest. When those two are completely the same number on the supply and demand, we'd be rated 100 on the middle index there. So right now, that's where we're sitting. This was the latest index that was pulled that I could pull for you. And then Chandler, which doesn't really have much to, in these days in the way of new homes, is sitting at the top of the Cromford chart as far as the seller's market at 220. That's up 7% from last month. Then Gilbert, then Glendale, then Mesa, then Avondale, then Tempe, then Phoenix proper, then Fountain Hills, Scottsdale, Peoria. Those are all going to be in sellers markets. And then we hit Paradise Valley and Surprise. Those are in balance markets. Cave Creek, Goodyear, those are going to be buyers markets along with, again, advantage to the buyer. Queen Creek, Maricopa City, and Buckeye, those are all going to be in buyers markets. And actually, we're seeing Queen Creek and Maricopa City and Buckeye all in the downward position as far as percentages. The highest increase was Paradise Valley at 19%, and the biggest decrease was Queen Creek at 12% on the index. And that's again in the buyer's market. So, guys, that's all I've got for you today. Really, I hope that was entertaining enough, informative enough. If you guys have any questions, would like to put together some strategies, talk about what we could do to get your property sold, get you into a property for the least amount of pain, and getting you through all the hiccups and getting you at the lowest payment possible, negotiating in or selling your property at the highest, best terms, let us know. We'd love to be able to talk to you again. Check us out at mincolagroup.com, mincolahomes.com. Always reach out to us at 480-788-8569 or email us at at mincolagroup.com. We'll see you guys next time. Thanks.